We'll go ahead and kick off. So thanks for joining. And we've got a lot to talk about this morning. I probably got way too many slides in here today, but a lot of different pictures to show you about what's going on in the markets. A lot of things happening at the moment. Considering that the U.S. crop is just, not even 50% planted, we've got a lot going on in the marketplace. So we'll dig right into that. And again, thanks for joining. What's going on? Well, the funds, probably the most important players in the market, have been for several months. We saw some heavy selling as we talked about all winter. Even last fall, the funds went big time short these markets based on a lot of these carryout projections, both in the U.S. at the world level, and that set them up for a situation of having to buy back some of that. And we've seen them very, very active over the last couple of weeks. We'll talk about that throughout the presentation. U.S. crop progress, we'll get the updated report this afternoon, likely show that we didn't make a lot of progress last week. South American crops continue to get a little bit smaller. We'll talk about that. The world wheat crops. Wheat's been the leader in the market the last few days due to some freeze frost in Russia and dropping the size of that crop potentially a little bit. So that's been one of the big drivers. Friday, we had USDA's first look at the 2024-25 balance sheets here in the United States. So we'll dig into those. And then, of course, the seasonals. And we usually preach a lot about the seasonals, but it's that time of the year, usually May, June, and July, or when the markets tend to make their highs. And we're getting a rally right now. So it tends to happen. And so, I think you need to, follow it pretty closely. And now's the time of the year to have some offers working. So starting out looking at some of these points, these are last Monday's numbers. Again, we'll get updated numbers this afternoon. But as far as the corn crop in the United States, 36% of it was planted. As of last Monday, that was 3 points below normal. I would assume we're probably dropping a little bit further behind normal last week, given the rain that we got in the Western Corn Belt especially. Soybeans were at 25%, running a little bit ahead. Cotton running a little ahead. Spring wheat running quite a bit ahead, but again, probably didn't make much progress last week. And winter wheat conditions have been improving a little bit with some of the rains we've seen in the Southern Plains. So again, we'll get this report this afternoon. But if you look at the progress as of a week ago, you can see on this map which states were ahead and which ones were behind. Right through the center of the belt, but especially Nebraska was 17 points behind. Illinois was 9 points behind. Iowa 6. So those states probably didn't make a lot of progress last week. And so we'll be curious to see those numbers this afternoon when they come out. Similar for soybeans, this Nebraska, Iowa, Minnesota area was the area that was behind. So we'll be kind of curious. And I did see on social media over the weekend that Friday, Saturday, several people from Nebraska were posting planting pictures. So I would assume that those folks tried to get quite a bit done here over the last 2-3 days. But if you look at why it's been a little bit slower, this is a 30-day percentage of normal precipitation map. Shows you where it's been wet, really from East Texas straight north. That area has been receiving more than normal rainfall and extending across the Mississippi River into Illinois. So kind of goes along with that corn map I just showed you just a second ago. Looking at the changes in the drought monitor, we've been talking all winter about being extremely dry really in that area. And if you look at the last 2 weeks, you've seen significant change, improvement in the green. We've also been paying close attention to Southwest Kansas, where it's been dry and getting drier. And if you look at the change over the last 8 weeks, especially, this area, this hard red winter wheat belt out in Western Kansas and the Oklahoma Panhandle has gotten worse, while we've seen improvement up here in this Western Corn Belt area. And so the current drought monitor, as you look at this right now and you compare it to some other years, this is about as good as it's looked for the entire country in a long, long time. And certainly a lot better than we were just, a month or two ago when the Western Corn Belt was showing a lot of red and such on it. So we've seen some improvement. We've recharged the subsoil. A lot of us, we've been trying to figure out, what do we want to have happen? Do you want moisture to improve the subsoil, or do you want to or do you want to get the crop in the ground? And so you can't have them both at the same time. Looks like we've gotten the subsoil charged back up. If you look at the next 7 days, we do see a planting window, it looks like, in some of these areas, Nebraska, Iowa, South Dakota, Minnesota. But as you get further south and east, it looks like we've got some rain coming over this period. So that should indicate who gets planted here over the next few days and who probably doesn't. And I saw this map this morning. This is a 10-day precipitation accumulation forecast map, and there's some pretty big numbers in here, especially down in from Texas, Louisiana, Mississippi, Alabama, but even also up into eastern Illinois and Indiana. Some talk of what, 7.5 inches, possibly. Looks like around French Lick, Indiana, somewhere in western Indiana. So we'll see if this happens, but this was one of the maps that I did see this morning. I thought it was maybe worth sharing. Now, a lot of the focus has been on El Nino switching to La Nina this year, and when's it going to happen, and what's the impact going to be on crops. And so if you look at the latest ENSO probability forecast, they continue to show La Nina building as you get out into late summer. 50% chance, it looks like, of La Nina or neutral in the June, July, August window. But especially July, August, September, and on, we see bigger chances. And what does that mean? Well, these are the latest CFS forecasts for the next several months, and they're continuing to talk about above normal temperatures. But I think for the last 3 years, we've seen these be above normal temperatures. So I don't even know what above normal temperatures are anymore. I take some of this with a grain of salt, but a lot of what we look at is the precipitation map, especially when we're looking at La Nina's arrival. And as you look at the June, July, August forecast here, much of the country, good, bad, indifferent, but this area right here from Mexico up into New Mexico, this is the planned arrival of La Nina, I guess. And typically the La Nina brings drier conditions that start in the southwest and then slide up into the middle part of the country. And as you go by period, July, August, September, then you start seeing more advancement down here of reds and oranges moving up into the western Corn Belt. August, September, October, you continue to see more advancement up into the west. September, October, November, you see, a greater portion of the country being impacted by La Nina. So what our hope is in production agriculture this year is that La Nina gets pushed back a little bit and the arrival really doesn't show up until after the growing season's over. So this is what we're going to continue to watch. We'll talk about La Nina for a while now, but what's the impact going to be and how soon will it be, I guess. For the folks in West Texas, certainly, this June, July, August, or July, August, September window looks like it's, potentially going to be the arrival. So moving on, switching gears a little bit, which markets are hot, which ones are not. Again, I'll throw a plug in for my market report letter in the afternoon, where we have this column every day and we point out the hot and the not markets. And we've got a lot of hot markets right now, which means that the relative strength index is up over 60. We've got stochastics up into the 70s and 80s and even 90s in some cases. When that happens, typically that means we need to be looking at some marketing opportunities, need to be looking at making some sales, or at least get some offers in to reward the markets. The not markets in the blue, those are the ones we don't want to be sellers of, or if you're a buyer, you can be a buyer, but feeder cattle, hogs, and crude oil are the ones that have pushed down into the not zone, we call it. And so, but over the last 7 days, we've really added several markets into the hot zone. And so some of the markets, I'll dig into the ag markets in a little bit, but some of the other charts that I've seen that are hot and not, the total U.S. debt is certainly a hot chart. We've now eclipsed $34 trillion, soon to be $35 trillion, I think. So this chart doesn't seem to have any turn back down to it. This I thought was an interesting chart. When you look at credit card debt versus savings rate, that credit card debt right now is at an all-time high. Whereas you look at the savings rate, I've got it kind of blocked off here, but United States savings is one of its lowest levels in a long, long time. So that's a bit discouraging, I think. as we look at the general economy. November rice. I don't usually talk much about rice, but rice has made a new high on Friday. So highest we've traded since early February. So certainly worth rewarding there. The rapeseed market, canola had a new high close, the highest it's traded since the end of the year. And so good opportunities there in the canola trade. And again, if you look at the RSI down here, the green line at 64, stochastics up into the 90s, would indicate that we probably need to be, it's a good time to be looking at making some sales. The Japanese yen is definitely cold right now versus the US dollar. How that's changed, because I remember back in the late 1980s when the yen was a powerhouse in the world, and the Japanese were able to buy anything they wanted around the globe, it seemed like, at that point in time. And now things have really changed, and Japan's facing definite recession at the moment, and having some issues with their economy. The cocoa market, I've pointed out cocoa last month. Cocoa traded to an all-time high, and now it's turned and gone down. And so if you're a believer in these indicators like the RSI, certainly when the RSI has been hot, there were some good selling opportunities, and now we've taken that back down into the 40s. So this market's certainly taken the bloom off there. The hog market, we had hogs in the hot zone a month ago. Now here we are making new lows. Hogs have traded right back down to their low from April. In fact, even gone below it a little bit. And so if nothing else, hogs look like a buying opportunity. You see the stochastics numbers down here, even pushing into single digits. Last time we did that was back here at the beginning of the year, and that was a pretty good buying opportunity. So I would say in hogs right now, probably more of a buy than a sell. Feeder cattle, kind of the same way, although, feeders have kind of been in this pennant formation for several months. We've been making higher lows and lower highs, but we're kind of pushing down towards the bottom of that channel right now. And so I would think that this is more of a buying opportunity in feeder cattle as we go forward. The crude oil market, crude's trying to find support. Looks like the 100 and the 200-day moving average lines around $77.50 right here. Looks like it's support. But again, the RSI and stochastics would indicate this market's probably pushing towards a bottom right now. So the funds, what have the funds been doing? Well, this is a chart as of Friday night. Now, this goes back through last Tuesday's trade. So these commitment of traders reports are about 3 days in arrears when we get them on Friday afternoon. But through last Tuesday, you can see what these funds have done in the ag markets and the grains and the oil seeds over the last really 2 weeks. They've taken their net position from negative 700,000 contracts to negative 200,000 contracts. It's been a huge buying run. And I guess I mentioned on my call this morning that in beans, they had their biggest week ever last week in buying. Corn, they had the second biggest week they've ever had in buying. So if you wonder why the markets have rallied a little bit, certainly give credit to the funds. They've been buying back a huge chunk of their short position. And as we look at the change and the impact of that, you go back to the end of March, beginning of April, and what happened at the end of March was we got the acreage numbers, the prospective plantings report at that time. Also had a grain stocks report that day, but the acreage report especially, when the government told us we were going to have a much lower corn acreage number than what everybody was expecting, you can see what the impact has been in the market since then. That corn has gained 6.5%, beans are up a couple percent, but cotton's been down about 10%. And that had to do a lot with that prospective plantings report. That kind of got the ball rolling. It didn't really, there was nothing concrete in that report, but it just was enough to get things moving. So look at the corn market. Last Friday's report, USDA made some positive changes for the market. They raised the ethanol number 50 million bushels, raised exports 50 million bushels on old crop corn, still ending stocks a little above 2 billion bushels, but that was down 100 million bushels. Average farm price fell a nickel to $4.65 a bushel in that report. When you look at the export numbers, I mentioned 50 million bushels. Exports have been decent so far this year. You can see we've had a few weeks of really good loadings. But compared to last year, exports are up generally. We've had, compared to the last 5 years, we're kind of right in the middle middle of the boat. But this is the area we needed to see improve if we're going to see the markets get any better. And we've started to see that a little bit here with these lower prices. They've generated some demand. When you look at where, first of all, you look at sales right here on the left, this great chart that Brock put out on Friday. Sales are up, both outstanding sales and shipments so far, but you can see who the big buyers have been and who's not been buying. Mexico been the biggest improvement for the year so far. China has been almost non-existent in corn buying so far this year. And so that's been the two biggest ones. But Japan's been up, Colombia's been up. The rest of the world's been buying more U.S. corn. So that's been a positive. And I think, Brazil had a huge crop a year ago, shipped a lot of corn. Now that they've kind of worked through that, we've seen some of the buyers coming back to the United States. The ethanol number, I mentioned it, up 50 million bushels. You can see ethanol production by week. Other than this week in January, which was the very, very frigid week that we had, and a lot of ethanol plants shut down. Besides that, we've seen a good year of ethanol production. We're running at capacity for a lot of these plants. And so if we can keep that up, that's a big positive here for the corn market as well. Looking at the stocks to usage numbers from the report on Friday, and this goes into 24-25. So USDA included its first numbers for next year. We'll look at the balance sheet here in a minute. But this year's stocks to usage at 13.9%. They're expecting that to go up next year with the growth in production. At the world level, we're looking at things pretty stagnant. This is amazing. 5 straight years of basically steady stocks to usage at the world level. And that, I guess it just tells me that when we produce a little more, we use it. And when we don't use as much. And at the world level, things are holding pretty steady. One negative note that came out of last week at the end of the week, this was on Friday, news story from Reuters that China came out with its estimates cutting its demand, its perceived import demand for corn, soybeans, and cotton next year. Corn to 13 million tons from 19.5 million tons, and that's significant change. You're dropping a third there, 6.5 million metric tons. Beans, not a big cut, 1.5 million tons from 96 to 94.6. Not a big deal there. Cotton is a big deal, down 2 million tons. And so that's not a positive for the cotton market as we go forward. So the funds, just in corn alone, I showed you the combined position chart a minute ago, but in corn, they were record short back here at the end of February. And now all of a sudden they've taken their net position down to just about 100,000 contracts short as of last Tuesday night. And we know they've been buyers here Wednesday, Thursday, Friday, and again this morning. So they may be looking to get this thing back to zero. Kind of like we've seen in several other markets last fall when the funds sold their long down to zero. Maybe they're looking to get covered. And so this week's movement and this Friday's report will be very interesting to see if they've bought back that entire short position, which was absolutely huge amount of buying. That was about 1 billion bushels of corn they bought last week. I think 900 million bushels that they bought. So huge buying last week. And if you look at their position, this is a great chart that Noble Ag put out. Second biggest week we've ever seen in corn buying. Only 2019, we had a week where they bought more. And so again, that was a huge amount. So July corn, I've got it in the hot zone right now. We had pushed back up at the close Friday, just under 470. This morning, we were up 3 cents right before we started. So we made a new high, traded to the highest level since back in early January. The RSI's pushing 70, stochastics pushing up close to 80. Tells me this market's probably getting a little bit toppy, or should be. If you're looking for an obvious target, the 200-day moving average line, the blue line up here at 484 3/4, looks to me like an obvious target. So maybe 480 is a good place to put a sales target in for July corn. And if I've got an old crop left to sell it at 480, maybe buy a call option just in case the market goes back up. And I'll look at some calls here in just a minute. But that might be a strategy to look at. Aside that, if we were to break through that level, now you're probably looking back at the December high at 512 as your next upside target. And of course, $5 is always a target for the market, but those might be some levels if I've got old crop corn left to sell. First, I think this 480 plus level, probably a pretty good place to be looking to make a sale. Now, looking ahead to new crop, these were USDA's balance sheet numbers from Friday. They had used the prospective plantings acreage numbers. They had right at 90 million acres of corn. They're still using a trend line yield at 181. A lot of us think that's a little bit aggressive. I'm using like 178, I think 179, probably in that area is my trend type yield. But the government, to offset that, is also expecting a jump in demand next year, 100 million bushels to 14.8. Where do you get that demand from? Well, ethanol is pretty well maxed out. This 5450 number, that we can't really grind anymore for ethanol. If you're going to increase demand, it's going to be in the feed side. It's going to be in the export side. Feed's going to be dependent upon increasing animal numbers, which we're not expecting a big number increase there. So exports is where it's going to have to be from. And, historically, anything over 2 billion bushels is pretty decent. And the government's expecting we're going to do that again next year. But with all of that, they're still expecting ending stocks over 2.1 billion bushels, which by itself is not a friendly number. Now, that said, 6 months ago, the government was talking about 2.5 billion bushel carryout. So compared to where we've been and compared to what we had talked about earlier this winter, this 2.1 is not negative. And then if you were to take this yield down 2 or 3 bushel an acre, now you're talking sub 2 billion bushel corn carryovers. So 440 corn is their average farm price. That makes sense given this type of a carryout. So we'll see what's doable this year. But again, you go back and look at the stocks to usage. I showed you just a minute ago, 14.2%. They're expecting average farm price at 440. And so that inverse relationship would probably hold. So what could happen? This is my updated stocks matrix for corn. And so the government says we're going to start with 2.02 billion bushels of corn. They're saying we're going to use 14.8 next year. If we plant their number at just over 90 million acres of corn, we harvest 82.2 million. Then within the matrix, this shows me all the different possibilities of acres and yield, what the ending stocks number would be. And right now, the government says 181, that's going to end your year a little over 2.1 billion bushels of corn. If you go down to 179 yield with the government's acres and everything else constant, now you're below 2 billion bushels. Last year's yield at 177.3 would give you a carryout at 1.8. Now, none of these are running out of corn, but it is getting a little more positive, I guess, maybe than where the market had been. And that's why the funds have been buying back some of their shorts. They're looking at, well, what if you're not real bullish on yield, if you take yield down 2-3 bushel, now you're looking at a little bit of a dip in stocks next year. And so if you're a fund trader, are you comfortable being short so much corn? Probably not. And I think that's why they're evening things up a little bit. So I think this is an important week. Will the funds finish the evening up process? And if they do, is that giving us our marketing opportunity that we typically see during this time of the year? And so if you look at December corn, 492 close on Friday. I think this morning we pushed right to the 200-day moving average. May have been able to nudge through that slightly here this morning. That was the first big target that we've been looking at. The next target on the chart to me is this gap that we left on January 2nd from 502.25 to 503. Another dime up. So I think that'd be a great place to be selling some new crop corn. Anything with a 5, I think would be wonderful. The RSI was at 64 on Friday, probably pushing up into the upper 60s this morning. Stochastics up into the 80s. So I think this all kind of fits together. If the funds, finish getting their short position covered this week, I think this is giving us a good window to be doing some marketing and getting some stuff locked in. And one of the goals that I always have is improving on the insurance price. Well, we're doing that. We're above 466. The margin protection price was at 509. We're not back there yet, but not far away. You can see the number of months we had a chance to market $5 corn. And if we're able to do that again, I would just be, I think, pretty ecstatic to be able to do that. The other thing we can look at is some option type scenarios. if you make a sale, maybe you buy a call or do a call spread or something like that. And so this was the option tree from Friday night's close. And the options that I'm looking at this year using are September short dated options on December corn. And the way these short dated options work, you could buy December options and they expire in late November. That adds a lot of extra time value that you have to pay for. And so you can use these short dated options like the September short dated option. It expires on August 23rd. To me, that gets me through the biggest part of the weather window. I don't have to pay as much money for the options. So for instance, if I were to sell corn today at 492 futures, for example, maybe I go buy a $6 call for 6.5 cents, pretty cheap, minimum price type contract. Maybe I go to a 550 call for 13 cents. Maybe I buy a 520 for 20 cents and sell a $6 for 6.5. So I give myself an 80-cent window for 14 cents, which was about the same as I would have paid for the 550 call, but I get my protection closer to the market at 520. So there's a lot of different scenarios you can look at with option type trades. Maybe if the market trades up, maybe I'd rather buy puts. I can buy puts, which set a floor under the market. So you could buy a 470 put for 19 cents, get a floor above 450. Personally, I like using the calls better because I can get myself a higher floor that way. But I just want to point out some of the different things you could look at here. If you're not comfortable forward selling as much, maybe you look at utilizing some calls as well to back up those sales. And then finally, the last chart I want to show you on corn, we've talked about this all winter long, was how 24 seemed to be mirroring 2014. And so I think this chart's pretty amazing what's happening so far this year, that we made our low in 2014. Now this is offset by about 30 days. So we're about 30 days early now than we were back in 2014, but you can see how the charts seem to be kind of mimicking each other. And this was the window where we made our highs in 2014. But then what happened after that? Markets went back down because we still had 2 billion bushels of corn, and we still, we had some uncertainty and we had some fund buying that gave us this rally, this seasonal rally. But at the end of the day, we ended up raising a crop, markets went down. So another reason why we want to take advantage of this, this early summer rally. Soybeans, look at the report from Friday. It was a non-event. USDA didn't change any numbers, still leaving ending stocks at 340 million bushels. Average farm price at $12.55. Exports just ho-hum this year, actually running light from where we'd been a year ago, mostly due to the large Brazilian crop last year and huge competition we saw from them. And as you look at where we're at right now compared to Brazil, Brazil is 90-something% harvested on their bean crop right now. But you look at the U.S. value of beans in pink compared to Brazilian beans in green, we're way priced above Brazilian beans right now delivered into China. So for the next 3 months, there's no reason that China would buy any beans out of the United States unless they just can't get them shipped out of Brazil. Otherwise, there'd be no reason. Out into the fall window, we become more competitive. And so we'll see if that does eventually bring some beans in. But if you look at you look at what's going on in exports right now between the United States and Brazil, we continue to see this divergence that Brazil is taking more and more of the bean market while the United States continues to be less and less. And this is something we kind of seen coming. And if you look at sales right now for new crop, right now out of the United States, we've sold 0 beans to China. So China would prefer to buy beans out of South America if they could. They've been cheaper, another big reason. And, consequently, the United States is shipping less beans to China. So maybe a reason for concern. Now, if you look at this year's crop numbers from USDA, the second column from the right, these are from Friday. These came out, USDA estimating Brazil's bean crop at 154 million tons. They lowered that 1 million. They lowered Argentina a couple million down to 50 million. That's still a combined record production number out of those two countries. And even if you take the Rio Grande do Sul state down, some people saying 3 to 4 million tons being lost because of flooding, they're still looking at a record. The one thing that really stands out from Friday's report that a lot of people didn't talk about was next year. USDA came out with its preliminary estimates for next year's Brazilian crop at a record 169 million metric tons, and Argentina at 51 million. So combined would easily be another record high. Now, they did the same thing this past year. So take some of this with a grain of salt, okay? These are probably going to be the biggest numbers you see for the year. However, we're still expecting them to continue to grow production. And so we're going to have to continue to use more and more beans domestically in order to chew through that excess U.S. stocks if we're not able to compete. Now, I mentioned what's going on in Brazil due to the flooding. Stone X lowered their Brazilian crop down to 147.8 due to some of the flooding late. So USDA may be a little late doing that. CONAB, the Brazilian government, will come out tomorrow with its crop report for this month. So we'll be kind of curious to see what number they're plugging in there. But looking at world numbers in beans, despite losing a few bushels off the top, the U.S. bean carryout and stocks to usage number this year expected to grow in 24-25. At the world level, expected to grow again this coming year. And so to me, that's a little bit, of course, that's bearish to price here as we go forward into next year. Now, all that said, we've seen good buying from the funds over the last couple of weeks, and the funds have bought back a huge chunk of their short position. Part of that because of the lower Brazilian crop, and part of it just because they're probably nervous going into the U.S. growing season with some of the planting delays that we've seen as well. And so that was what we'd all hoped for, that these funds would buy back their shorts, and we've seen that happen. And I think it's given us a good selling opportunity. But last week's buying was a record for any week that we've ever seen, the most they've ever bought. 100,000 contracts, that's over 500,000 bushels. Somebody pointed out that that's well over this year's entire U.S. bean carryout that the funds bought back last week. So it's a huge, huge amount of beans. And you can see what the impact has been on the market. Through last Tuesday, it was a heck of a rally. We took beans up $1 a bushel. And now we sold back down at the end of the week. Today, we're rallying back a few pennies. So, again, use these rallies as a good opportunity to do some marketing. We've taken beans out of the hot zone. We had them there last week. Now we're back into more neutral territory, and beans are probably not the strongest of the big three right now. Wheat and corn probably 1, 2, and then beans somewhere down below. Just based on those fundamentals, you look at the world carryout numbers, it's not, we're not in a tight situation. We're not in a tightening situation, especially when we're growing these big crops every 6 months somewhere around the world. From a marketing perspective, a month ago, we were talking about the 100-day moving average, the purple line. We've gone through that, well through it. The blue line, the 200-day moving average at 1287. And then you got a chart gap a little above $13. Those would be some targets for old crop beans, but I probably wouldn't have any, and probably wouldn't have had any for quite a long time. Looking ahead to new crop, these were to me, the biggest numbers out of this report on Friday. USDA using 86.5 million bean acres, which would give them a crop. They're saying 4.45 billion bushels of beans. They're bumping demand up to 4.36. That's assuming 125 million bushel export increase, assuming 125 million crush increase. I can see the crush number based on a lot of the new plants coming online. The export number, based on what China's actions have been so far, if Brazil continues to grow a lot of a big crop, it's just hard for me to see that we're going to see that increase in export demand. But even with that, USDA expecting ending stocks at 445 million and expecting ending price at 1120 next year. So I'm a little bit tenuous here. Now, at the end of the day, can yield get to 52? We haven't been there before either. So, maybe it's safer to use a yield a half bushel lower and maybe fudge that export number down a little bit. Maybe that's a little bit more conservative. But if you look at what could happen this year using the USDA numbers as far as stocks and demand, using their acreage number, at 51 plus bushel per acre yield, you're over 400 million carryout. At 52.5, you're at 500 million carryout. So if we get this 86.5 million acres of beans planted, you could still see the yield slip back a little bit and still, basically have the same carryout you had this year. So it's going to take something pretty dramatic, I think, to get real bullish beans based on the U.S. Production numbers at this point in time. And so again, if you compare stocks to use to farm price, that inverse relationship holding true. USDA saying we're going to bump to 10.2% stocks to usage, and they're expecting the farm price to fall down to 11.20. So again, I think it points out reasons we want to be sellers. That $12 number looks pretty good. We've been above it a couple of times here this spring, including the middle of last week. We got to 12.30.5 as a high, right up against the 200-day moving average, and couldn't trade through it. The market turned back down. This morning we were up a few pennies, but we're still above $12. So I want to watch the RSI. You get this up into the 60s again. Probably you nudge up under that 200-day moving average. Probably a good marketing opportunity. If you're a little more bullish, you do have a chart gap, 1237 to 1244.5. Maybe we try to go back and fill that at some point, but I think that this is a good window here, up or over $12 to 12.25, to be doing a little bit of marketing. You can improve on your insurance guarantee by 70 cents or so. I think that that's a great opportunity here for this year. Switching over to wheat. The big story in wheat has been this Russian crop. All of a sudden, the frost freeze that is probably going to take the top off of the Russian crop. It looks like Sovicon dropped their estimate 3.4 million tons here over the weekend. And so that has gotten the funds back in the wheat market. But why is it a big deal? Well, these are some pretty good charts that Standard Grain put out showing world production or world exports. Why is Russia a big deal? They're 24% of all of the world exports in wheat. And so you can see the United States accounts for, just over 19. So 19 million tons compared to 52 million tons. So Russia's the big deal. And so, at the end of the day, but also the EU, Australia, they're having a little bit of crop issue in some of these other countries as well. So something to keep an eye on there. And Russian wheat production, at 91.5 million tons, that was a week ago from USDA. Sovicon, I mentioned, dropped their number below 90. So we'll see how that changes throughout the year. But taking that crop back down certainly is a benefit to the market. Now, USDA did make one change. They did bump exports a little bit. Friday's report, 10 million bushels, took ending stocks down 10 million. This is still a 3-year high in ending stocks in the U.S. So most of that stock is soft red winter wheat. We've cut the hard red winter wheat crop back last year. So it's most of the wheat we've got is what we would call non-exportable or non-preferred exportable wheat, I guess. The good wheat, the hard wheat, is what we have less of. Now, looking ahead to this year, these were USDA's numbers from Friday. Production-wise, they're saying that total wheat production a little up from last year, a little below the average trade estimate, so it was a little bit friendly. And you can see as you look down through the classes, hard red winter wheat up from a year ago's drought year, so still not stellar, but up from last year, up a little bit above average trade estimates. Soft red winter wheat, for whatever reason, came in well below the trade estimate and well below last year. And the only thing I can think of there, that's acres, because condition-wise, the soft red winter wheat crop looks really, really good from what I've seen. So that's got to be acres is the big reason there that USDA lowered that number. And sales so far this year, if you look at the U.S. numbers, USDA a little bit optimistic, and I mentioned that they did bump that number up a little bit. But you can see who's been buying a little bit more wheat. And really, the rest of the world, it's not the usual buyers, but some unusual buyers have been stepping in and buying wheat this year. So looking at the world and U.S. numbers, world stocks to usage estimated to jump to 40% the year ahead, while world numbers continue to decline a little bit. And if you take that Russian wheat crop down a little, now you're down maybe down to 24%. You might be down to the lowest you've been in 10 plus years. And so I think that that's what's really got the attention of the wheat traders here over the last several days. And, if you look at stocks to use in major exporting countries, especially, this is the tightest we've been in a long, long time. This goes all the way back to 1960. And so that, changes the picture of the wheat market just a little bit here. And so that, again, the reason we've seen this wheat market take the lead. Now, U.S. balance sheet numbers, USDA did bump things this year, even though acres are down, yield up a little, production up a little bit, and ending stocks at 766 million bushels. However, average farm price they still think will lower to $6. So that might be a little bit on the low side given what we're seeing in the marketplace right now. And so soft red winter wheat, funds have been big buyers. They bought back about 60,000 contracts, bought a little more again today. So they're taking their short position. Looks like they're trying to work its way back to zero. And you can see the impact in the market. We've rallied over $1 a bushel. I've got wheat in a hot zone right now. We've taken out the 200-day moving average. We've traded up. Now today we were up, I think, 17 before the webinar. So we're up 680 wheat. We've gone back to the highest level since clear back last August right now. RSI is up into the mid 70s, stochastics up into the 90s even. So this market's probably ripe for a bit of a correction, but again, it kind of boils down to where the funds decide they're done buying. And, you know, is it possible to rally back to the summer high last year? I guess you can't rule it out at this point, but if you want to take advantage and scale up, sell, I certainly think it makes sense. We've traded back above the insurance price at 661. So I think it's an opportunity to be, you know, chipping into this, especially if you get some good looking wheat like I've seen in the Eastern Belt here so far this year. Looking at Kansas City, hard red wheat, the funds have covered almost all of their short position as of last week's report. They were only short about 25,000 contracts or so. I saw this chart I thought was interesting, the seasonal chart in Kansas City wheat. And this is the time of the year when the markets kind of tend to make their highs before trading down into harvest. And so it's a great window to be doing some marketing. And so looking at Kansas City July wheat, you know, we've rallied it over $1 a bushel. And this morning, again, back up to about 690. We've taken out this year's highs, traded back to last fall levels. So not quite, you know, up to the insurance price yet. But again, not a bad opportunity to be scale up selling. RSI is probably in the 70s now. Stochastics up into the upper 80s. Again, pretty good opportunity if you've got a good crop to be looking at doing a little scale up selling. Finally, hard red spring wheat, the Minneapolis contract, funds have been buying back as well. Bought back over half of their short position in the last 2 weeks. And finally, this market had just been a huge slide. And finally, we've been able to get this thing off the schneid a little bit. And you can see a week ago when the high was made at 731, we had the RSI well up into the 70s. Stochastics were indicating a sell. Here this morning, I think we're back up close to that 730 level again. Not seeing the exuberance in the spring wheat market that we're seeing in the winter wheat market, but this 200-day moving average, pretty good opportunity here to be doing some marketing there as well. So for wheat people, hopefully you've had that opportunity. For September, new crop wheat, again, similar looking chart. We're at 726, probably up 5-6 cents from that. So pushing back to last week's high. This 200-day moving average at 740 looks to me like a good opportunity to be making a sale here for some summer or for some spring wheat into the fall. And we're above the insurance price again. So a good opportunity to increase your guarantee. Finally, switching over to cotton. USDA still can't figure out the production number from last year, where the cotton came from. Now, they made a big drop to the harvest date acreage number, made a big increase in the yield. Production basically was unchanged. Went from 12.1 million bales to 12.07 million bales. So USDA just messing with the accounting, it looks like. They did raise domestic usage slightly, took ending stocks down just 100,000 bales to 2.4 million bales. So still a tight number. And it doesn't really, you know, jive with what's going on in the market right now. But if you look at the world numbers, U.S. numbers going into next year, USDA is forecasting more acres, bigger stocks to use. World level, we've got ample amounts of cotton available. And you couple this with some of the world economic issues that we're seeing right now, especially from some of our big buyers like China. You know, I think that's what the market's looking at. And the market's just saying, you know, look, we're not increasing demand for this stuff. And if we're going to increase acres in the year ahead, it's just, you know, there's just no upside unless we see a big drought again. But if you look at the inflationary numbers, the PPI numbers out of China, you know, and China went through 4 straight months of deflation. Finally, they've turned back into the blue. but they're still not seeing the economy really grow at this point in time, and their PPI numbers continue to be negative, which, you know, is what the cotton market tends to look at. The cotton market tends to look at these Chinese growth numbers. And if China's not growing, cotton market has trouble moving. So the funds, just the opposite. The funds have been sellers in cotton. And one of the things I've mentioned all winter was that it looked to me like the funds were going to continue to sell until they got to zero. Well, they're at zero now. So will they quit selling? I think that's the biggest question here as we go forward. I would tend to lean towards a yes, that the funds probably would be sold enough. I don't look for them to want to go short this market, especially without going short the other markets. And as you look at the indicators, the RSI at 36, stochastics are still in the 30s, but markets in the not zone right now. 75 cents looks like pretty good support on July cotton. We haven't been able to get back above the 20-day moving average, failed at that last week. If I've got old crop left to sell, you know, this 85-ish number would be a great target up here at the 200-day moving average. I just don't know that we can get there at this point in time. So probably 80-cent cotton right below the 20-day moving average probably looks like a pretty good target right now. Now, looking ahead to next year, USDA did raise its acreage number, but especially its harvested acreage number. You know, the last 2 years, we've seen a lot of abandonment in cotton acres. This year, we're going in expecting it's going to be a normal year. We'll see what happens. With a normal type yield, you would see cotton stocks grow. I would tend to think that these are the most bearish numbers you're going to see from USDA on production. So I would tend to want to probably hold off on making any sales. USDA says 74-cent cotton. That wouldn't be very, very pleasant, but that's kind of where the market's at right now. But again, I think this market's probably oversold. I'm probably going to sit tight. And if I'm looking to make some new crop hedges, you look at all these longer term moving averages, the 200, the 100, the 50-day, all up around 80 cents. To me, that's a good target as any right now to be making some sales. Beyond that down, I'm probably going to sit tight and wait and see what happens. So the seasonals, I mentioned that back at the beginning, and I've mentioned it several times throughout, but this is the monthly average corn price of December corn for basically the marketing year from November to October. The month of June is the high over the last 18 years. Doesn't happen every year, but again, this year, it kind of seems that we're working that direction. This April, May, June window is typically when we see our best opportunities. And so I went back here and what I've highlighted in this chart are the years when prices were above the insurance price. And so, you know, you go back, you know, last year, for instance, we didn't have any, you know, the insurance price was the high of the year. You know, we didn't see any opportunities after that. But oftentimes this May, June, July window is when we see our best marketing opportunities in corn. So we definitely want to take advantage of that when we get it. With soybeans, it's back a little bit, this June, July window, but I would throw April, May, June, July, August, all kind of in there. Again, it's a lot better marketing beans during the summer than it is at fall. You know, this October, November, December window is not a good time to be marketing a soybean crop. And so again, you can go back and look at the history, but we oftentimes see good opportunities to improve on the insurance price. So we want to take advantage of that. With cotton, the highs come earlier typically over the last 18 years, month of April. And that's the planting time. And that's when the cotton market oftentimes has had to try to buy acres over the last several years. But even throughout the summer, we do get opportunities to improve on the insurance price. And so we do want to take advantage when we get them. Spring wheat, May, June, that's our highs over the last 18 years. And you can look at the prices throughout the history. So if you want to get a copy of these, I'll be happy to share them with you. But I want to show you and just continue to reiterate that the seasonal opportunities are right now. And by the time we have this meeting next month, will be second week of June. So between now and then, you know, it's an awfully good time to be making some sales. I also want to update on some of our county products, margin protection, ECO, SCO, all of those products. And I do want to mention with NAU Country, we have worksheets available out on our agent portal. You can access these through the resources tab. We've got a tab for indemnity and profitability worksheets where you can get to all of these: the revenue loss trigger, the SCO, ECO worksheet, stacks, margin protection, our profitability matrix. But looking back at last year, these we're going to expect to see a lot of these county policies trigger payments, especially at the 95% level, but even at the 90% level, and especially on crops like corn. And I would just about guarantee that in any of these orange and red colored counties that are highlighted on here, and even in most of the light green counties, we're going to be looking at getting ECO and or margin protection payments at the 95% level. Those payments are expected to come out, well, the final county yields are expected to be posted no later than June 14th by the RMA. Last year, it was on June 14th. So I don't expect them to do us any favors. But now that the production deadline is passed, which was the end of April, all farmers' production has been turned into crop insurance. Now the RMA can take those numbers by county and compile those and then put out those county yields. So that's going to be when we know what these payments are going to be. And within days after June 14th, we should start seeing payments made for those policies for last year. And so that's good news for folks that bought 90, 95% insurance policies, even 86 in some areas where SCO might trigger some payments in some of these orange counties, especially. So I showed you some examples last month, but again, even these light green counties, when I ran some of these, would trigger some fairly substantial payments. That means that the yield was slightly above trend, but because the price dropped so far last year, that's what's going to trigger the payments on some of those high level policies. So for this year, I forgot to add the updated chart in here, but for this year, for margin protection insurance, I wanted to show you what's going on so far. For margin protection, we have set the final harvest price. I call it harvest price, but the final price for urea, DAP, and well, potash as well, but diesel fuel. All of those four inputs they're not going to move from now on. Interest rate is the only input that's going to move. So what would the potential look like for payment on margin protection insurance? Well, it's going to depend on two things, price and yield. And now that the prices have gone up, that would lower the potential for a payment. So here's an example for Champaign County. If a person had 95% margin protection with a 120 protection factor, and if the county yield did not change, input prices went down, what works out to be $14 an acre. And as of today, with $4.90 corn, we would not be triggering a payment for margin protection. A month ago, when we were looking at this, that payment was around 50, 60 bucks an acre because we had corn price down around 440, 450, 460 a bushel. So that's why, as you look at the matrix on here, if you were to take corn back down to 448, back to where we were at 100% of a county yield, you'd be looking at $81 an acre. And so right for now, I'm looking at this 100% column, figuring we're going to have an average crop in the counties. But you can see as the price goes up, of course, we would move away from getting a payment. But it also shows me that somewhere down around 480 or so, is about where our break even is. Below 480 corn with an average yield in the county is where you start to trigger payments. So margin protection insurance, ECO, these high level products, to me, you're providing, if we assume an average crop going into the county, I basically have a put option below 480 corn. And so I kind of have that in the back of my mind as I'm doing my marketing that, yeah, I want to try to improve on that. But at least I know I've got something protecting some bushels if the market goes down. So these inputs aren't going to change except for interest rate. Interest rate doesn't make a big difference in the policy. So from here on, you're basically looking at a revenue policy with margin protection, with ECO, SCO, those types of products. With soybeans, soybeans actually still would trigger a payment. Now, the biggest reason was, and if you look at corn, urea is the biggest one of our variable inputs, and urea went down, $63 a ton. And so because of that, the average input costs went down. Whereas in soybeans, of course, we don't have urea. We just have DAP, potash, diesel, and interest rates. So inputs actually basically stayed unchanged. And so you just basically have a 95% revenue policy. And if we assume 70 bushel yield in Champaign County, then you could look down here, anything, in the low 12s as a price would trigger a payment. And at 12.10 on Friday, you'd be looking at a $16.63 indemnity payment. So with an average yield. So we got a long way to go throughout the crop year, but I just wanted to update everybody on this policy. What's happening right now with the inputs, that's kind of behind us at the moment. So now we're looking at revenue, we're looking at yield, we're looking at price, and we'll see what happens as we go through the year. Also want to mention a tool that NAU has called R-Powered. Why is R-Powered a big deal? Well, it's available now for 2025. And the reason I want to mention it, R-Powered allows you to basically lock in your insurance price for next year if you wanted to. And you've got D's 25 corn trading up close to $5 a bushel this morning. And so is that a good time to be doing it? I don't know. You know, a person could do the same thing just by selling corn at $5 for D's 25. So you can go hedge corn and you don't have to pay for it. But this tool does allow you to lock in your insurance price if you're wanting to do that as well. And so if I look at November beans, we're up around 12 bucks. Maybe that's a good opportunity to lock something in there. The other thing I'd point out on this chart is this chart gap. I didn't draw it on the chart, but we've got a little gap up here around 1205 in D's corn for 25. And on November beans, you've got a little gap that we traded up to, you know, just under 12 from about 1205 to 1215. So those might be some good, you know, targets for that market to get back to. It might be some good selling opportunities there. Now with the R-Powered tool, for the agents that are on the call with us, you can do a number of different things. You can lock in the price on a given day. You can do these bundles, which add a bunch of different periods. You can go pick your own period. So I can go, you know, starting right now, I can do, you know, all of the month of May. I can do first half May. I can do June. I can do, you know, there's a lot of different things I can do for pricing windows to add to my insurance window in the month of February. And then this shows you how the quotes work out. So for locking in that today, it would cost me about 18 cents a bushel to lock in today's price. So it's not a cheap product. But if I'm worried about it getting away from me next year, if I want to lock something in, I can do it. Or I could just go to the market and hedge 480 corn, 498 corn, or whatever the number is. So there's a lot of different things we can do. I just wanted to point out that this is available. So coming up tomorrow, we'll get ConAb's Brazilian crop report. We'll see if they have any changes to the Rio Grande do Sul yields based on the flooding. Monday the 27th will be Memorial Day. Markets will be closed that day. June the 12th is our next WASDE report from USDA. I don't anticipate they'll step out and change yields yet for new crop, but we'll certainly be looking at demand numbers. We'll talk all about it the following day in our aftermath webinar on the 13th. June 28th is a big day. We'll get our next planted acreage report from USDA, as well as a quarterly grain stocks report that day. This acreage number will be kind of a big deal that day. Now, we don't even have the crop reporting done yet at that point. So, you know, FSA data is not available yet. So they're going to be basing that mainly off of surveys at that point in time. So these are not final, but they are the numbers that the government's going to use more than likely all the way into next winter. And so that'll be a big set of numbers for the balance sheets. And then July 4th is Independence Day, and the market will be closed that day as well. So I thank you for listening. Hope you have a great spring. Hope you have a successful planting run and get the rest of the crop in the ground. And we'll look forward to visiting again in June. If there's any questions, certainly shoot them at me. But if not, or you can shoot them at me later, give me a text or an email, and we'll be glad to try to address those. So if not, thanks for joining, and we'll talk to you again soon.